I want to share a story about a Wednesday morning that changed everything for a man named Gerald. Gerald is 69 years old and has been retired for about 4 years. He dedicated his professional life to serving as a superintendent at a middle school district for over 3 decades, managing financial records, overseeing staff compensation, and ensuring that every cent within the system was properly tracked and documented. He knows how money works. He is disciplined with money. He has been disciplined with money his entire life. 4 years ago, when Gerald stepped away from his career, he made the same decision that many cautious, responsible people make. He gathered his retirement funds, money he had spent 30 years carefully building, and deposited everything into his bank, a community bank he had trusted for more than 2 decades, the kind of place where the tellers recognize your face. He placed everything into a single account because it felt secure, because it was comfortable, because no one ever suggested there was a reason to do anything differently. Last year, Gerald received a notice, not directly from federal tax authorities, but from his bank, informing him that they had submitted a federal report concerning his account. A report that had caused his account to be flagged for examination by federal financial oversight agencies. Not because he had done a single thing wrong, not because even $1 of his funds was questionable, but because the way his money had been sitting in that account and the way he had been moving funds through it, transactions that seemed completely ordinary from his perspective, had activated automatic federal reporting requirements that Gerald had never once been made aware of. Gerald reached out to me. He was not furious. He was something far more unsettling than furious. He was scared. He told me, "I gave 31 years of my life to earn this money. I followed every rule. How is it possible that following every rule landed me in this situation?" I spent nearly 45 minutes on that phone conversation walking Gerald through 5 specific regulations governing bank accounts and IRS reporting that the vast majority of retirees have never been informed about. Regulations that are currently on the books, regulations that are actively being enforced right now, regulations that determine precisely when your financial institution is legally required to submit reports about your account to the federal government without your awareness, without your permission, and with no requirement to notify you before doing so. By the time that conversation ended, Gerald fully understood what had taken place. And more importantly, he understood exactly what adjustments to make going forward so that this situation would never repeat itself. In this video, I am going to share with you everything I shared with Gerald. The 5 things every retiree needs to understand about how much money to keep in a bank account, what sets off automatic federal reporting, and what you can do starting today to safeguard yourself and your hard-earned savings. This is not about concealing money. This is not about evading taxes you genuinely owe. This is about understanding the rules of the financial system that your money already lives inside. Rules the bank is not going to walk you through and that the IRS is certainly not going to mail you a helpful summary about. Stay with me. Before I walk you through the 5 rules, I need to be absolutely clear about something, because this subject tends to attract a great deal of false information online, and I want everything I tell you to be anchored in documented law. The rules I'm about to explain are not speculation. They are not fringe theories. They are established federal statutes and IRS regulations that have been in force for many years. Some pieces of them you may have encountered before: the $10,000 rule, the structuring prohibition, FDIC coverage limits. But partial knowledge is dangerous when the complete picture is what actually keeps you protected. Here is the broader problem that affects retirees in particular. Most seniors accumulated their savings during a period when banking rules were more straightforward, when the relationship between a person and their financial institution was less complicated, when placing a substantial sum of money into a single local bank account was the obvious, safe, and sensible thing to do. The regulatory environment has changed considerably since that era. federal reporting obligations have grown. Electronic monitoring has intensified. The dollar amounts that trigger automatic federal reports have not been updated for inflation in several decades, which means that balances that would have been considered ordinary modest savings 40 years ago now sit comfortably above the reporting thresholds that were established when those levels were originally created. And here is the particular vulnerability that retirees face. Seniors are frequently moving money in ways that are entirely normal given their stage of life, taking distributions from retirement accounts, receiving Social Security payments, handling proceeds from an inheritance, consolidating funds following the passing of a spouse, covering significant expenses like medical equipment or household renovations. These are entirely lawful transactions. They have perfectly reasonable explanations behind them, but several of them can, without proper awareness and account structure, activate federal reporting requirements that create the appearance of a pattern that the IRS or FinCEN, the Financial Crimes Enforcement Network, is specifically trained to examine more carefully. Gerald's experience was not unusual. I encounter variations of it on a regular basis, and every time, the individual at the center of the situation is someone who handled their finances correctly, but simply did not know the reporting rules surrounding the system their money was operating within. You are about to learn those rules. If you want financial and legal guidance that shields your savings before you ever find yourself in a difficult situation, hit the subscribe button right now and enable the notification bell. That is precisely what this channel is here for. Now, the 5 rules. Rule number 1, the $10,000 cash transaction reporting requirement. I am starting here because this is the rule that the most people have encountered, and the one that is most frequently misunderstood in ways that produce genuine consequences. Under the Bank Secrecy Act, a federal law that has been active since 1970, any cash transaction involving $10,000 or more must be reported by the financial institution to the federal government using what is called a Currency Transaction Report, or CTR. This filing is automatic. It is required by law. The bank has no ability to choose whether to submit it, and you do not need to have done anything improper for that report to be generated. Here's the first thing most people do not understand about this rule. The $10,000 threshold applies to cash, meaning physical currency, not to personal checks, wire transfers, or electronic payments. If you deposit a $10,000 check, no CTR is submitted. If you deposit $10,000 in physical cash, one is. That distinction is important. Here is the second thing most people do not understand, and this is the piece that caught Gerald off guard. The CTR is not itself a red flag. Banks submit millions of them every single year, and the overwhelming majority result in no follow-up action whatsoever. What transforms a CTR from a routine administrative filing into something that draws closer scrutiny is when it appears alongside additional patterns of activity, which leads me directly into rule number 2. A critical note here about what you should actually do if you ever need to deposit or withdraw more than $10,000 in cash. Do it. Do not avoid it or rearrange the transaction to stay beneath the threshold. The deliberate act of restructuring transactions to prevent the $10,000 reporting requirement from being triggered is itself a federal offense, regardless of whether the money involved is completely above board. More on that in rule number 2. Rule number 2, the structuring law that ensnares innocent people. This is the regulation that most directly explains what happened to Gerald, and it is the one that has led to the most unjust outcomes for law-abiding individuals, including a meaningful number of seniors in recent years. The federal structuring prohibition, codified at 31 U.S.C. Section 5324, makes it a federal crime to divide up financial transactions specifically to avoid activating the $10,000 CTR reporting requirement. On the surface, That sounds entirely reasonable. Deliberately hiding substantial cash movements should be against the law. Here is where the problem lies. The law does not require the government to demonstrate that you were aware of the reporting requirement. It does not require the government to show that your money was improperly obtained. It does not require the government to prove that you intended to evade taxes or engage in any other wrongdoing. Under the structuring law as it has been applied, and the Supreme Court has addressed this in ways that remain actively debated, the government can pursue a structuring case based entirely on the pattern of transactions, regardless of the innocent reasoning behind them. The IRS and FinCEN operate pattern recognition systems that specifically search for what is referred to as sub-threshold structuring, a series of deposits or withdrawals that each fall just below $10,000, occurring in a sequence that suggests deliberate avoidance of the reporting threshold. Seniors are especially exposed to this risk because of entirely innocent behaviors. A retiree who receives a large insurance payout and deposits it across several visits to the bank because making one very large deposit feels uncomfortable to them. A senior who makes periodic cash withdrawals from savings to pay contractors for home improvement work because that is how those workers prefer to be compensated. A retiree who moves savings from several accounts over the course of multiple weeks in amounts under $10,000 because they want to proceed carefully and deliberately. Every one of these patterns can prompt a structuring inquiry, not because the money is questionable, not because any criminal intent exists, but because the pattern matches a profile. An important note on what you should actually do. Deposit and withdraw money in amounts that naturally reflect your genuine financial activity. Do not artificially adjust transaction figures based on what you imagine the bank is monitoring. If you have a substantial amount to deposit it all at once. A CTR will be submitted, and that is perfectly acceptable. What is not acceptable, and what creates genuine legal vulnerability, is a pattern of transactions that looks as though it was designed to remain beneath the reporting threshold. Rule number 3, the FDIC insurance limit you may already be exceeding. This rule is distinct from the first two. It is not about government reporting requirements. It is about protecting the money you have worked your whole life to accumulate from something most retirees have not thought carefully about since the financial crisis of 2008. FDIC insurance, provided by the Federal Deposit Insurance Corporation, covers bank deposits up to $250,000 per depositor, per bank, per account ownership category. That means if your bank were to fail, the FDIC guarantees your deposits up to that ceiling. Here is the problem. Many seniors, particularly those who have brought their assets together following retirement, after the passing of a spouse, or after receiving inheritance funds, carry balances that exceed $250,000 within a single financial institution. And the great majority of them have no idea that the portion of their balance above that threshold is entirely unprotected. If that bank were to fail, an event that seems remote until it occurs, and that has occurred multiple times in recent memory, the funds above the FDIC ceiling are not covered. They enter the general pool of the bank's remaining assets. You become an unsecured creditor, and recovering those funds is not guaranteed. For seniors living on fixed incomes who cannot absorb the loss of a portion of their savings, this is not a hypothetical concern. It is a real and addressable one once you understand it. An important note on what you should actually do: add up your total deposits held at each bank. If any single institution holds more than $250,000 in your name, consider moving the excess to a separate financial institution or a different account ownership category, such as a joint account with your spouse, which carries its own independent $250,000 limit. in order to bring each covered category beneath the insurance ceiling. This is not a complicated process. It is not a tax maneuver. It is simply understanding how the protection that covers your money genuinely functions. Rule number 4, the 1099-INT reporting threshold and what it means for your savings interest. This rule is the quietest one on this list. It produces no enforcement actions. It creates no legal risk for honest people. But it costs seniors real dollars every year in the form of taxes they could have prepared for and planned around had they simply been aware it existed. Every bank is required by the IRS to issue a Form 1099-INT to any account holder who earns $10 or more in interest over the course of the calendar year. That form goes to both you and the IRS directly. The interest recorded on it is considered taxable income. Ordinary income, taxed at your applicable marginal rate, layered on top of your Social Security payments, your pension distributions, and every other income source you receive. For seniors who are carefully managing their overall tax burden, particularly those for whom additional income can trigger increased Medicare premiums through IRMAA, or can push a greater portion of Social Security benefits into taxable territory, interest income from savings accounts is not a minor background detail. It is an active variable that requires deliberate management. Here is the specific issue at hand. At the present time, interest rates on savings accounts are substantially higher than they were 3 to 5 years ago. A retiree holding $200,000 in a high-yield savings account at 4% interest is generating $8,000 in interest income every year. $8,000 that is fully taxable. $8,000 that may push total income above a threshold that triggers higher Medicare premium assessments. $8,000 that most account holders never factored in when planning their income picture for the year. An important note on what you should do. Understand how much interest your accounts are generating. Determine whether that interest is affecting your tax bracket or your Medicare premium calculations, and consider, with the support of a certified public accountant or a qualified financial advisor, whether tax-advantaged alternatives for some portion of your savings make sense for your personal circumstances. The 1099-INT will show up whether you are ready for it or not. Being ready is simply a matter of choosing to be informed. Rule number 5, the suspicious activity report you will never be told about. This is the rule that completes the full picture, and the one that most directly explains how a financial institution can submit a federal report about your account without ever informing you that it has done so. In addition to the mandatory CTR for cash transactions exceeding $10,000, banks have both the authority and, in many instances, the legal obligation to file what is called a Suspicious Activity Report, or SAR, with FinCEN whenever they observe account activity they believe may be connected to potential money laundering, structuring, fraud, or other financial offenses. Here is what makes the SAR fundamentally different from the CTR. A CTR is filed automatically based on a specific dollar amount. You know the threshold exists. The bank acknowledges it. It is transparent. A SAR is filed based on the bank's internal assessment of the nature of the activity. There is no specific dollar trigger. There is no automatic mechanism. It is generated through the review of internal compliance personnel. And here's the piece that most people never learn. Federal law prohibits the bank from informing you that a SAR has been submitted about your account. They are legally barred from disclosing it to you. The report is transmitted to FinCEN. FinCEN distributes it to relevant law enforcement agencies, and you have no knowledge that any of this has taken place. What categories of activity can prompt a SAR filing? Transaction patterns that are inconsistent with a customer's known financial background. Sudden significant increases in account balances without a clear source. Repeated cash activity. transactions that appear to lack a reasonable financial purpose, substantial account movement that conflicts with the customer's stated employment or income level. For seniors who may be receiving funds from an inheritance, a large insurance settlement, the proceeds of a home sale, or who are consolidating accounts following a major life event, these patterns can appear in their accounts through entirely innocent activity. An important note on what you should do. Be ready to explain meaningful changes in your financial activity if your bank's compliance department ever contacts you. Maintain records of major financial events, the sale of a property, receipt of an inheritance, an insurance settlement, so that if questions are ever raised, you can present a clear and documented explanation of where the funds originated. And if you ever receive a call or written communication from a bank asking you to explain specific transactions, consult with a financial attorney before providing any response. You have not done anything wrong, but having the documentation to establish that fact clearly and immediately is what genuinely protects you. Let me bring all 5 rules together one final time. The $10,000 cash reporting rule. Cash deposits and withdrawals of $10,000 or more trigger automatic federal filings. It is standard procedure. It is not harmful on its own. Do not attempt to avoid it. The structuring law. Breaking transactions into smaller amounts to stay beneath the reporting threshold is a federal offense regardless of whether the underlying funds are legitimate. Make deposits in natural amounts that reflect your actual financial behavior. The FDIC insurance ceiling. $250,000 per depositor, per bank, per ownership category. If your balance exceeds that amount, the portion above the limit is unprotected. Distribute your funds accordingly. The 1099-INT reporting threshold. $10 or more in earned interest is reported to both you and the IRS. In the current higher interest rate climate, this income is meaningful and taxable. Know that figure before tax season arrives and the suspicious activity report. Your bank can submit a federal report about your account without ever notifying you, based entirely on observed activity patterns. Preserve documentation of significant financial events and be ready to explain them clearly and completely. 5 rules, every single one of them grounded in real law. Every one of them being applied to seniors across this country right now, and not one of them discussed at the bank when you first opened your account. Gerald restructured his finances within a month of our conversation. He distributed his savings across several institutions to stay within FDIC coverage limits. He created a straightforward documentation system to record any large financial transactions. He consulted his CPA regarding the interest income he had not previously accounted for, and he has not encountered a single problem since. He contacted me 6 months later and said, "I really wish someone had explained this to me 30 years ago." You are being given that explanation right now. Share this with every retiree you know who holds significant savings in a bank account. Share it with your adult children. Share it with anyone who is helping manage the finances of an elderly parent, because these rules apply whether you are familiar with them or not, and your bank is not going to walk you through them at the counter. What happens if you believe your bank has filed an inaccurate or unwarranted suspicious activity report that is now interfering with your ability to conduct routine banking? Watch the next video where I walk through exactly what your rights are when a financial institution flags your account and the specific actions you can take to defend yourself and maintain access to your own money. I will see you there.